buying power is increasingly being concentrated in the hands of a small number of discretionary fund managers. But what does that mean for investment trusts themselves? I'm Mark Coggett, and I'm discussing this topic with three experts. They are Matthew Hose, Vice President, Investment Companies Research, JPMorgan Cazenove, David Willcox, Investment Director, City Asset Management, and Lee Robertson, CEO of Investment Quorum. David Willcox, there's increasing consolidation in distribution. Does that mean investment trusts are going to have to get bigger if they're going to survive?
I think it's somewhat inevitable. You're seeing a number of wealth managers merging in the sector. That's creating more centralised buying processes, investment processes, centralised research teams. You're seeing businesses which have typically operated more independent regional offices being brought under the sole distribution of, sole control of perhaps one research team, centrally located. So I think inevitably you're applying more capital to the same space. Therefore, you may need bigger trusts in order to do that.
Lee, do you get that feeling? And if so, what's the sort of economic minimum?
I do. I'm unsure what the economic minimum is, but I agree with that point. It's not just that. I think advisors, many of them are outsourcing investment management now to discretionary managers, so they're giving up their own. So it's not just large nationals that are consolidating. It's also the fact that centralised investment processes are also often now run by a relatively small number of DFMs on behalf of the advisor community.
Matthew, how do you see that trend play out as you look across the industry? Where's it going long term?
Of consolidation. I mean, given those trends we've just talked about, greater consolidated buy-in, more use of model portfolios, we would hope to see greater consolidation by investment trusts, because there are some investment trusts which verge on the border of uneconomic. But I think the difficult thing is combining investment trusts. I mean, the old adage is with board members is that turkeys don't vote for Christmas. We would like to see more mergers, but unfortunately we never see as many as we would like.
But Christmas always comes around about the same time every year, so I presume there's sort of shareholder.
But I think in the last 18 months we've had possibly one investment trust merger. Now, when we do see them, they are very successful at lowering costs and obviously stripping out the fixed costs that are involved with investment trusts, but they don't happen very often.
Well, if we could sort of separate the investment trust industry into two parts, the sort of the illiquid specialist side, which I guess probably has slightly different dynamics from the more mainstream. But David, if you start to look at, say, a more mainstream trust, what percentage of the overall costs in it are fixed, so things like directors' fees and so forth? I'm just trying to get a feel for how merging actually really helps bring costs down to the benefit of shareholders.
I don't think I think cost is one element to it, but you've also got liquidity. So I'll just step away from cost for a second, because I think it's probably, whilst that's one part of the conversation, we would be more concerned if we're happy with the underlying investment strategy and returns of the trust. Costs are one element to it, but you've got to consider the liquidity of the trust. So, for example, as a firm, we try not to own more than 5% of any investment trust. Just as a personal experience, we found that if we own 5, the ability for us to exit and enter those positions becomes quite difficult, because there just isn't enough capital from the market makers to supply us with a position. So we need to find a seller in order to make a purchase. However, because there's a shortage of capital in the sector. So that's our main concern when it comes to size. Probably that's more important to us than considering whether a merger is going to create a lower cost structure if we're already happy with the fund itself.
And Lee, from your point of view, how do you manage liquidity as a risk?
Exactly the same. I mean, we're a very small buyer, so we've not really had these issues up to date. We're only 150 million in total of client assets, so it's not an issue that we've particularly struggled with. And we tend to buy in when they're at a discount anyway, so that's when we tend to use investment trusts. So that's been quite decent for us.
Is that quite difficult to do at the moment?
Because everyone spots the discounts, of course. So, I mean, some trusts, they go on forever with a discount. Some of the F&C stuff, etc. But it has definitely become much more difficult. And if you look at the really popular, UK equity income, which has been such flavour of the month, it's virtually impossible at the moment.
Well, Matthew, there are trusts being launched even today. What can they do on day one to give shareholders a sort of sense of security that liquidity will be there in the future?
Well, many trusts are launched with promises in the prospectus to reach a certain size by a certain date. Otherwise, they'll offer to give money back to shareholders, either a form of redemption or a tender, for example.
Okay, and Dale, I mean, in terms of trusts, how do you supply liquidity to trusts? Can you give us an example of a trust that it goes about it the right way for you?
Okay, so for us, not a trust we own, but a firm that we know very well would be Troy Income and Growth, which is a conventional UK equity income and growth fund. The Troy team took over the management of the fund from Glasgow Investment Managers a number of years ago. The first thing that they did was create a buyback policy where they bought back stock when it traded at a discount, and they promised to do so under all circumstances. They then effectively provided the buying community with liquidity on the other side by saying, if you want stock, we'll issue to you at 2% premium. So what happens on day one is the trust shrinks quite dramatically as everyone who needs to get out gets out, and once all those people have exited, then as more buyers come in, you begin to see the trust grow a little bit more. So that would be for us the best example that we could think of.
Would you ever consider buying a trust like that at a 2% premium, or do you only ever buy at discounts?
Yeah, if we think the manager is going to add value over the long term, then I think there is a case for doing that, because you're taking away that risk that your discount could suddenly go from 1% to 10, 15% suddenly overnight, a change in market circumstances. That makes us feel a lot more comfortable. What we dislike is where trusts don't have those sorts of protections and are trading at very tight discounts. That's quite unappealing.
And how about yourself, Lou? I mean, are you happy to buy a trust at a premium? Or?
We would do, but we haven't. As I say, our strategy has always been looking for discounts, and it's served us and our clients very, very well. But that's not to say that we wouldn't if we believed in the manager and believed there would be value add.
And when you look at, everyone says they want to buy at a discount, but what's the sort of level of discount that, as a buyer, gets you interested?
Any discount for us. We overlay it with it's not just about the discount. It's about, do we believe in the manager? Do we believe in the asset class? Do we believe in what they're trying to do? And then we look for the discounts thereafter.
Similar case with you, Tom?
Absolutely. I mean, we kind of describe it as an appropriate discount for the trust. So we often take into account the historical range of the discounts available. If you've got a trust that's historically traded at a very tight discount, but is to 1 or 2%, but is now trading at 7 or 8, that might be attractive in relation to its historical range, and that might be an entrance point for you. It's not to say that it has to be it has to be a 20% or a 25% discount. There's no absolute number.
Okay. Now, we've been talking a lot about trusts in quite liquid sectors or with liquid underlying assets, but what's the future for those trusts that invest in much more illiquid assets, such as property, infrastructure? How would you look at them differently, Matthew?
Well, I think the key to those sectors is that they use structure, and you can't put illiquid assets like property, private equity, hedge funds in the open-ended structure or in ETFs, for example. So as long as those trusts or those investment companies which hold those assets remain relevant and continue to use the structure, then we think they'd have a very healthy future.
And again, just coming back to what we talked about originally about how large a trust has to be viable. What happens when you go to these more illiquid places? Can a smaller trust survive longer, and justifiably so, because it's niche?
Potentially so. It depends on the costs, but ultimately whether a trust's viable depends on its shareholder base, because it's shareholders that are paying those costs. And if shareholders deem that trust not to be viable, some shareholders sell it and put it onto a discount, then there's more incentive to wind the trust up, so it becomes increasingly unviable.
I can see that, but I suppose there's been a pressure over time to bring fees down just generally across funds. I mean, when you're looking at trust, it's probably a bit rough and ready and it's a bit unfair, but is there a sort of thing that if you see the total fees are over, say, 2%, you think, oh goodness, we better have another look at that? Or what's the sort of figure that...
I think it's worth, when you talk about fee pressure, distinguishing between the fee pressure we're seeing because of open-ended funds, which is in the conventional investment trust space, the traditional trusts, and also the alternatives, where there has been some fee pressure, mainly due to excessive fees in a small number of cases. But that's not an area where we are seeing fee pressure. On the second part, I think you've hinted at a sort of a broad rule of thumb we have is if you have ongoing charges below 1, that's pretty attractive. Between 1 and 2%, that's acceptable. Anything over 2% starts to get unacceptable, and you've got to look at how much value the manager's adding against that and whether it's really worth paying ongoing charges of 2, 3, 4%, because that can really eat into your cumulative returns year after year.
And talking about the sort of issue about liquidity again, I mean, how do you, where does it become an issue for open-ended funds? Because again, we're seeing big consolidation in open-ended funds, larger and larger ones emerging. How do you judge liquidity when you might look at, say, a really good small open-ended fund? Do the same rules apply?
Internally for us, yes. I mean, we use slightly different percentages for open-ended funds than we do for closed, but we do have a set percentage that we won't go above, and we monitor that on a monthly basis to make sure that we're not too much of any particular fund.
Is that higher or lower than it would be for an
It's higher. The open-ended control is higher than it is for a closed-ended. Yeah. So.
And do you see any evidence that smaller funds tend to do better than large funds, just because they're more nimble?
Yeah.
Or is that a myth put out by small fund managers?
Is that an open-ended? For open-ended funds or closed-ended funds?
Both.
Okay. I have to say, our experience has suggested to us that a manager running a smaller amount of capital can take positions and do things that a larger manager cannot. So the opportunity set for that manager, therefore, is broader. And if you've got a broader opportunity set, there's a better chance that you'll outperform over longer term. Fortunately, the industry we're in, as Lee's pointed out, data is available to everyone. So as soon as you get a significant amount of outperformance, capital is going to appear in your fund, and that's going to be great for you in the short term. But over the long term, it's going to be detrimental to your ability to outperform.
Well, given that, how quickly do you have to move between spotting an advantage and I guess getting everybody in the firm to say that's a good idea? From the liquidity side, compliance side, it all makes sense.
Very quickly, yeah. I would say. And it's getting quicker all the while. The information flow is faster and faster. We're now seeing what were originally information providers going into D2C, if you think of maybe TrustNet, etc. So I think it's getting much, much quicker, and they're identifying these things very quickly and getting the message out to their clients. So I think it makes all of our jobs a little bit more challenging.
We have to leave it there. Lee Robertson, David Willcox, Matthew Hose, thank you very much.